Hello, everyone. This is Ben and Janko. Welcome to our QX Financial podcast. Hello, everyone. We're very excited to have you back. We are here on the episode number
8.
Episode number 8. Thank you, Ben, of the QX Financial Podcast. As we always tell you guys, we have no fee, no charge for this. We don't run any advertising in our podcast. The only thing that we ask you to do for us is if you like the content of this podcast, please go ahead and refer this to a friend, tag them in our posting on social media, let them know that this great content is here. Maybe they can get something out of it. So again, if you find it valuable, please help us, do us a favor to get the word out there that we're trying to make a difference in people's financial lives. So today, we're very excited to share with you who we have here. We have one of our good friends. His name is Keith Conley. He's how would you call it, an expert in the student loan industry.
Yeah, absolutely. We've worked with Keith for a number of years, and Keith really is the West Coast expert in student loans. He's CFP, has worked as a manager for a student loan servicing company through the state, and has had a wealth of experience in that industry. So definitely appreciate Keith giving his time to share with everybody about some of the important things that people need to know about their student loans. So thank you, Keith.
Pleasure.
Thanks. How are you doing today, Keith?
Chilling like a villain.
Yeah. Ready to get going. All right. So I know we're going to talk about student loans. For those of you that are not listeners yet of QX Financial, if it is your first podcast, we talk about financial issues that are relevant to the country right now. And definitely, the student loan industry is right now on target. We have, political campaigns going on right now. They're talking about how the student loan debt is a big factor in the economy right now. We have all these things happening around us. So that's why we wanted to talk about student loans today. So why don't you give us a bit of your background, Keith? What you've been involved with? What have you been doing? Let us know a little about you.
Sure. So my first exposure to student loans was my own student loan. I graduated with my graduate degree with $38,000 in student loans. I didn't know anything about the process, and truthfully, even after I started to repay, I didn't really understand the process, but I just knew that I had to pay $300 a month. And as I got involved in pastoral ministry and then also later on working at the student loan servicer, I just kept meeting people who had student loans and were having trouble repaying them. At the student loan servicer, I was doing anything from helping people fill out the FAFSA and qualifying for student loans. As well, later on, I was promoted into a supervisory position in the default collections department. Today, I regularly consult with student loan borrowers concerning all of their repayment options, helping them understand what their options are in plain English, and telling them the truth about what their repayment program is going to do for them now and in the future.
Fantastic. And just for those that don't know, what is the FAFSA?
The FAFSA is the free application for federal student aid. It's required to fill out with your financial information in order to receive financial aid to go to college.
I see. Okay. Well, before we go into the details about what options are out there for people with student loans and all that, tell us a little bit more about, as you've been doing this work for so many years, what are you finding out there? What is the environment you're finding with the students, with these people, with these debtors that have to deal with these student loans?
Honestly, it's a lot of mass chaos. People don't really understand their student loans. They think that they have one loan when they have multiple loans They have loans that they don't even know exist. They might be paying Navient on one loan, and then they have another loan with another servicer that they don't even know about and have fallen into default. I'm finding that people are telling me, well, I'm in an income-based repayment program, but I'm not going to qualify for student loan forgiveness, and so I have to educate them on the repayment options, because if you're in an income-based repayment program, you are essentially in a program to get the loan forgiven, but yet a lot of people are in the mindset that if I'm going to be an income-based repayment, I want to pay it off as soon as possible. And that's just not the purpose of income-based repayment. So I just find that there's a lot of confusion and lack of education out there because the student loan servicers are not motivated to explain the programs.
I see. Okay. Well, like a lot of financial products, people don't know what they get themselves into, and then problems arise. So I know, Ben, you have some questions for Keith.
Oh, absolutely, Keith. I think misconception that a lot of young people have is, for starters, that they may not qualify for financial assistance through income-based or needs-based financial aid, may not be aware of all the scholarship and grant opportunities that are available to students, particularly students from lower socioeconomic status backgrounds, various minority groups, and so forth. And I saw a statistic several months ago which was indicating that almost 50% of college-bound students that are actually eligible for needs-based or other types of financial assistance, not loans, never even fill out the FAFSA. And what's your experience in this regard, as well as some of the things that you've seen?
What I find is that people are very eager to just get loans. They figure that they have to go to the expense of college. The only way they can do it is to pay with it through student loans, and they think that they're going to get a job when they graduate making an absurd amount of money. They're going to be making $150,000 as soon as they get out of college, so taking out this $8,000 loan,
Makes
8
sense.
times over the course of your college career isn't a big deal, because I'll just pay it off because I'm going to make a lot of money. And reality really says that a large percentage of college graduates won't even get a job in their career or in their field of study. A lot of people don't realize that there are many ways to pay for college. You just have to get creative. Case in point, you can have your employer pay for part of your tuition. It's like a little over $5,000 a year. And if you're interested in becoming a hairstylist, and if you find a salon, a chain of salons that will pay for your tuition, why wouldn't you do that? You're getting on-the-field experience, and you're getting your education paid for. And that could be salons. I mean, it could be really anything. But those options are out there.
I see.
There's many ways to pay for college, and we shouldn't just assume that we have to do the student loan.
I see. Okay. So walk us through a little bit over the scenario. So let's say you have somebody that reaches out to you and say, okay, I have this debt is overburdening me. It's too difficult to deal with. So tell our listeners a little bit about the steps. What is the first thing that you ask? What do you look for? And from there, what are their options?
Well, when you look at someone's student loans, the process is that I look on the federal website to verify where all their loans are located with which servicer, because there are multiple servicers contracted by the U.S. Department of Education to manage these student loans. And like I said earlier, it's very easy to have a loan with one servicer and another loan with another one, and have multiple loans all over the place, so you're sending payments to multiple places. And I'm also able to see the status. Is it in deferment, forbearance? Is it in repayment? Is it late? Is it in default? And that will tell me a lot about the programs that they're going to be eligible for. Once I analyze all of the loans, what I do next is I get information concerning the student loan borrower's income. There's a number of different ways to verify that. And then I also verify their family size. And again, there's a number of different ways to verify that. When we're looking at income-based repayment options, the only two factors that matter are income and family size. How big your loan is doesn't matter. How much money you make and how many people you help support is the only two factors that matter. Now, if you have a low balance, it may not make sense for you to do an income-based repayment, and my advice to that person would be just pay it off as soon as you can.
Right.
If they're making a lot of money, it's still possible that an income-based repayment option may make sense. If they have hundreds of thousands of dollars in student loans, they still may have a relatively high payment, but I've seen people with payments $3,000-$4,000 a month.
Wow.
Because they have hundreds of thousands of dollars in student loans, but I might be able to qualify them for a $500 payment.
So here's a good question about that. So let's say that individual that the bank says, or whoever the servicer person is, that your payment is $4,000. They go to you, you're able to reduce that. Does that mean they're going to end up paying more interest? Does that mean that the loan is going to continue to get bigger through the years? Or how will that work?
Yes, if you get an income-based repayment, chances are that your balance is going to continue to grow because you're not going to pay off the interest every month. But again, if you're in an income-based repayment, the purpose is not to pay off the loan. It's to get forgiveness at the end of a specified period of time. And depending on which program you qualify for, your repayment term or your loan forgiveness term might be as little as 5 years, or it could be as many as 20.
I see. Okay, so you're just making a payment of 20 years. You can potentially not have to pay whatever balance is being accumulating in there.
Right. The thing that a lot of people don't know, though, is that depending on the program, and there's just so many variables, but depending on the program, that may be a taxable event, whatever the balance is that's forgiven.
Right.
But if, let's just say you have a easy number, $100,000 student loan at 6% interest. Would you rather pay, $100,000, 6% compounded over 20 or 25 years? Or would you rather have a tax payoff of a tax liability of $150,000 and be in a 24% tax bracket?
Correct, and that's just the income tax on that money.
Right.
Exactly, so it will be a much lower cost, and you can even stretch that even further if you need to.
Right.
That makes sense.
So Keith, could you give our listeners a little bit of an overview of the different types of programs that are available? I think something that we've alluded to in past episodes of our podcast is that many individuals, Jonko and I have talked to, aren't aware that they qualify for some of these programs, and how significant of a benefit they could potentially be to them.
Yeah, most people assume that because they don't work for a nonprofit or they're not a teacher, they do not qualify for loan forgiveness. That is not true. If you qualify for an income-based repayment and it makes sense for you to make that payment based upon your income and your household size, you will qualify for loan forgiveness. We could talk about the variables on your repayment terms or how much we would expect your payment to go up in the future based upon increases in family size or decreases in family size and increase in income. But there are a number of different programs. There's teacher loan forgiveness, there's public service loan forgiveness, and then there's just the plain vanilla student loan forgiveness for anybody that doesn't fit in those categories.
So now, are all loans the same? Is private and federal bank loans the same? Would everybody qualify for something like that, or is it very specific type of loan?
It's only federal loans in good standing.
Okay.
So if they're in default, you're not going to qualify for a loan forgiveness program, or if they are private loans, these loan forgiveness programs are not for private.
That actually makes me think of a good question for you, Keith. So what are some of the major differences between these private loans that, maybe the listeners have heard of some of those, like the Parent Plus loans, and so forth, and comparing those to the federal subsidized and unsubsidized loans. Really, what's the difference between the two, and how do you know which loans you actually have?
Well, the best way to determine whether or not they're private or federal is to review your student loans on the student loan website, National Student Loan Database System. If all your loans are listed on that website, they're federal loans. If they're not on there, then they're private. If you have a Parent Plus loan, that is a loan that is technically the loan of the parent. The child has no responsibility, according to the government, on repaying that loan. If in the event the loan were to go into default, it would be the parent's paycheck that would be garnished, not the child's. And the repayment options are very much limited for Parent Plus loans.
So, what ultimately would happen if you have a student who had a loan co-signed by the parents? Maybe it's a federal loan, maybe it's a private loan, and for whatever reason that student isn't able to generate income such that they'll ever foreseeably be able to pay it off. Maybe it's a private loan, so they won't be eligible for the student loan forgiveness programs. How is that going to impact the parents of the families that have co-signed these loans?
If the parent is a cosigner on a federal loan and the loan falls into default, it's going to affect the parent's credit rating.
How so?
Well, once it goes into default on the 90th day, a federal trade line is put on their credit score on both the primary borrower, the student, and the parent. Mm-hmm. When loans go into default, it's a major problem because they're gonna, after the 90th day, they're gonna put that federal negative trade line on your credit score, showing a federal student loan in default, which is never a good thing. It's almost the worst thing that you could have on your credit score. And they're going to be eligible to potentially garnish your paycheck up to 15% of, I believe it's net income, and they're going to be able to take any federal money. So for older people, senior citizens that have student loans and they fall into default, that would include your Social Security. They're going to be able to take a large portion of your Social Security, and they're going to do that until you make an entire year worth of payments on that defaulted loan.
Wow, that sounds like it's a really big deal.
It is. I believe truly that this is the next financial crisis.
It is a major problem, and for you guys that are listening to this, there's a lot of articles right now about, how quote-unquote millennials are bringing down their parents and their grandparents because of situations like this. I believe also that if the student becomes diseased, it doesn't matter. You still have to pay it, right?
These loans will never be liquidated or written off because of bankruptcy.
Right.
It's almost never the case that you can get rid of student loans due to bankruptcy. These are loans that will stay with you for life. And what I have found is that increasingly there are a large number of people who are 60 years or more who have significant student loan balances. Mm-hmm. They retire at 62 and start collecting Social Security, and then they decide they're going to go to college with no intention of repaying the student loans, because once they graduate, it's not like they're going to go and get a job. They're retired and they're living on a fixed income, and so they're not able to pay the loans. They don't understand the process, and lo and behold, they fall into default, and now half of their Social Security paycheck is gone. It's a serious issue that happens more often than you might expect.
Exactly. So here's when we go back to our message, guys, with the QX Financial Podcast, is that financial planning needs to be holistic financial planning. There's other ins and outs of all these things that we do that we assume they're normal, because signing on for those loans, I didn't have any, but I remember going to college and how easy that was. Just couple of forms, submitted, boom, and these kids are borrowing $40,000, $100,000. I've seen as high as $200,000 of student loans with our clients, and they don't know how they got all the way out there. you know, and it's gonna, like you said, Keith, it's gonna be with them for the rest of their lives.
I've seen loans as high as $1.5 million.
Wow.
Whoa.
Is that in any relation due to the fees and penalties that are associated with, going into default collections and
Right.
that sort of thing?
If you're just in a standard repayment and deferring the loan, the balance is growing. And then, like I said earlier, when it falls into default, they tack on a 19% fee once you're in default. The good news is that if it's your first time in default, there is a way to get out. It takes 9 to 10 months. It's called the Loan Rehabilitation Program. You can actually complete that program and have the garnishment stop after making 5 months of payments. Payments could be as low as $5 a month if you qualify. And then at the end of the program, your loan is put back in good standing. They remove the negative trade line, and then you're eligible to enter into other loan repayment programs. But people don't understand these things because they just avoid the student loan servicer, or the student loan servicer doesn't explain the consequences for just ignoring your student loan. So people are just blindly saying, well, I can't pay $1,200 a month, I'm just going to defer it. And the student loan servicer is happy to do that because the balance just keeps growing.
Exactly. But, the other point of it, zooming out a little bit on this too, is this is the reason why a lot of young people can't afford to buy a home. This is the reason why they can afford to get married. That's the reason why they can afford to start a business and improve their financial standing, because they're shackled by these loans. So I agree with you, kid. It's a time bomb waiting to blow up for a whole generation of people that are financially trapped. They can't go because they can't get rid of those loans.
My message to anyone listening is that if you're considering college, find a different way. If you're a parent whose child is going to college,
let's talk.
under no circumstances should you take what's called a Parent Plus loan.
What is that?
A Parent Plus loan is when Johnny wants to go to a college and he's not able to take enough student loans to pay for the tuition. The parents can take out a loan based upon their credit worthiness. The loan does not belong to the child. It belongs to the parent. Hence, it's a Parent Plus loan. The income-based repayment options on those are very limited, and they belong to the parent. The student loan servicer is going to look to the parent. It's all nice and good to have this understanding with your child that they're going to pay this loan. But in the end, if for whatever reason they're not able or unwilling or don't do it, you're going to be on the hook. And that's going to jeopardize your financial future.
Oh, yeah.
I know plenty of parents who have not been able to save for retirement because they're paying over $200,000 of their child's student loans.
Exactly.
And so my message for those parents is you're probably going to end up living with your child later in life.
Exactly. So, full circle, right? We graduate, we live with them because we can find a job, and then mom and dad has to live with us because they have to pay for that. So we always say this, guys, college planning is financial planning. It's such a big item. There's so much money involved in that transaction that it's better to sit down with somebody and actually figure out, is there a better way? I can almost say, like Keith, is getting those loans is the last, maybe not even an option. Don't even look at some of those loans. I 100% agree with that. Ben, do you have another question for Keith?
Yes. So Keith, for some of our listeners who are in that situation right now, maybe they have 40,000, 50, 60, 80,000. Maybe they went for advanced degrees, master's degrees, doctorate degrees. Have student loans well over $100,000, $200,000. What are some solid ways that they can take action now to do something about it?
Well, I provide a service where I give them all their options. I sit down with them. We look at their loans together. I explain them in plain language. And I look at their income and their family size, and I explain all their options, and then they're able to make an objective, informed decision as to which plan makes sense. There are dozens of third-party consolidation companies here in Orange County. I've consulted with a number of them. They come to me and ask what they should do or the process for different programs. The difference in working with me, if for someone who has student loans working with me, is that I'm able to sit down with them as a financial services professional and take an objective look at their financial future and whether or not it makes sense for them to enter into income-based repayment based upon their income today and the income that they're going to be looking at in the next several years.
Okay, and we'll put all the information in the description for sure, so they can reach out to you. So what will be a great phone number, great email, your website?
Yeah.
Let's plug you in.
Yeah, well, my website is conleyfinancial.com, CONLEY financial.com. You're able to reach out to me there. Just let me know that you want to meet with me. I have clients all across the country, meet through video conferencing, cell phone, all the time. So if you're in Portland, Maine, don't feel afraid to contact me out here in California. I regularly help people anywhere with their federal student loans.
Fantastic. So again, guys, the worst thing that you can do is do nothing. So if you have questions about your loans, if you would like to know about your options or how can you leverage on that and how to integrate all this into your financial plan, make sure to reach out to Keith. We work in tandem with Keith. We know he's a successful, honest, integral individual that will try to do the best for you guys. So if you have any questions, you can reach out to us. We'll put Keith's information on the description. And again, if you have anything else or something that you would like us to ask Keith for a future episode, please let us know. We will be more than happy to add that to our next conversation with Keith. So we'll try to make a series of these based on you guys' feedback.
Absolutely, and coming up in the next few weeks, we're going to have Dr. Phil on, not that Dr. Phil. Dr. Phil has a Juris Doctorate. His practice focuses on estate planning. He's an estate planning attorney working with folks to do wills and trusts and things of that nature. And so it'll be great to hear him speak about some of the things that most people don't really think about until later in life that they should have probably in place right now, like a will, potentially a trust, medical power of attorney, and those sorts of things, and some basic things that people really need to know about planning for the future.
Fantastic. Well, thank you guys for being with us today. Thank you, Keith, for coming. Again, if you guys know of anybody that needs to hear this conversation about student loans, please, we ask us a favor. We don't charge any fees. We don't charge. We don't get any advertising return. We're doing this for people to learn more about their financial lives. So if you could please refer them to our podcast, it will be greatly appreciated. That's the only fee that we charge for this. Thank you so much, Keith. You guys have a wonderful day, and we'll talk next week.
The views and opinions expressed in the QX Financial Podcast series do not necessarily represent the views or opinions of the Ohio National Equity Sales Company or affiliated company. Before making any decisions concerning your personal or business financial situation or decisions concerning the information contained herein, you should consult a competent licensed professional. No offer, solicitation, or specific investment advice expressed or implied is being provided, and this podcast series and the information contained herein should not be regarded as such. Securities offered through the ON Equity Sales Company, member FINRA SIPC, One Financial Waste in Ohio 45242, phone number 513-794-6794. Benjamin Morgan offers investment advisory services through ON Investment Management Company on Income.
Keith Conley is not associated with Ohio National Equity Sales on ESCO or on Income.